Hey guys, welcome back to the second part of this first week video. This week we're going to cover some basic stuff in regards to Canadian programs. It's tax season. I've already posted two older video that I previously made about how to charge the government taxes. Please don't let your mind scare you in regards to the number that I use. It's a question of learning, and also these numbers are not that scary as you build your knowledge and understand what's out there and available for you out there to execute on your dreams. So one of the first thing to know about the different programs in Canada: TFSA, RRSP, RRIFs, RRIFs, as well as RESP, are our basic plans. Like I said, go have a look at the how to charge government taxes to find out more about the beautiful things you can do in between these different programs. These things are programs, they're not account, and that's really important to understand, because within each of these programs you can have different types of accounts, self-directed or not, checking, savings, etc., direct investing, so stocks, GICs, mutual funds, etc. In RSPs you can get all the same things, self-directed or not, direct investing, so stocks. You can write third-party mortgages if you have self-directed RSPs, mutual funds, bond, GICs, so on and so forth. The important characteristic of each one of them, and the red lines that you see in between each one of them, hopefully it's visible for you guys. Like I said, we'll work on getting this better. You can see that money can flow from TFSA to RSP, from RSP back to TFSA, from RSPs to RRIF, back to RSPs, back to TFSA, can come down to RESP, can go from TFSA to RESP. So the money can move around, and it's important to understand how to move it around so it's efficient and that we create momentum for our own self and creating wealth for our families. So we start with the TFSA here. TFSA, the important characteristic of this is that your growth is tax-free saving account. It adds up every year, so every year the government adds up more room that allows to contribute. Also important to understand that you have additional room every year, in the sense that if you move money out of a TFSA, the following year that room is added back onto your contribution room. And so it can add up very quickly. Again, go back to the videos that I've posted previously. So this is a very, very, very powerful tool for any Canadian, and how to use this properly. Then you have a RRSP. RRSP is for longer term, deferred growth. You have new room every year that adds up based on your income, and if you don't use it, it moves forward until the age of 71. The most important thing to know about an RRSP is that it's a tax deduction. And what does that mean? So you get no tax deduction to put money into a TFSA, but whatever money you take out of there is tax-free. So that's a good thing, and that's the key thing. Here, the key thing is it's a tax deduction. So that means that when you file your taxes every year and your tax payable is brought down to zero, then you cannot use what's called your tax credits anymore, so your business expenses, that kind of stuff. You have to carry them forward or lose them if you haven't been able to use them in time. And that only allows you to bring it down to zero, your tax payable, and then you got to carry it forward. With a tax deduction, the RRSP, what happens is that it's not a tax credit, it's a tax deduction. So even if your tax payable is zero and you contributed $10,000 to your RRSP, it qualifies for a tax deduction. That means that if you're somebody that has a 30% marginal tax bracket or income tax, you would get $3,000 back, and the government will send you a check for $3,000 to pay you back the taxes you've made on that money. Now, if your money grew in a TFSA tax-free and you move it from a TFSA out into your checking, which is non-taxable, and then from your checking to your RSP, you will still trigger a tax deduction, even though that money is non-taxable. That tax deduction will be based on the income you declare that year, not including whatever money you take out of there, because it's tax-free. So that's really important, and that's a very powerful tool again. And if you go see those videos I made, you can see how that creates a wheel Wheel of Fortune, I guess you could call it. There is a maximum age to contribute to RSPs, 71, but there's no age to start withdrawing from RSPs. And so it stacks if you take it out, like everybody says, right? But the important thing about that kind of stuff is to plan properly, tax planning, right? So first of all, I would never recommend, and I'm saying that, but I don't see a scenario where I would recommend to anyone to take money straight out of their RRSP. There has to be a way to take that money out, either through this channel here, or the RRSP offers some sub-program that can afford sometimes, depending on your life circumstances, some tax advantages. So one of them is the home buying plan, and one of them is for education, for example. And then I'll take the example of the education. Most of the time, when people go back to school, it's because they lost their job or they're taking a pause or whatnot. So their income is lower. So that means that if you take money out of your RSP for education and you don't repay back, then you lose that room, but your taxable bracket is much lower because theoretically or hypothetically, you're not earning as much money. So when you go do your taxes, instead of being taxed at like 30%, you might be taxed at 20%. I'm just pulling numbers out of my butt, just to make you guys understand what the idea here. So sometimes it might be tax efficient to take money out of your RSP to go back to school and not necessarily repay at all, depending on the situation, right? So that would be one way of looking at tax efficiency with RSP. The other way is, like I said, there's no age where you can start moving money from your RSP to your RRIF, which is a registered retirement income fund, right? So, for example, for myself, I have a RRIF, and so I can move money from my RSP or shares into my RRIF, and then from there's a minimum every year that I have to take out. There's a minimum withdrawals, right? And that then is part of my tax plan, because then I know every year how much at least I need to withdraw or how much I want to withdraw. And then that becomes part of my overall tax picture, whatever other incomes I have and all this. So I don't need to wait until I'm really old and there's lots of money. I can start a little bit before. I don't need to drain it neither, but I can, start a little earlier, right? It's not just one solution for everybody. So this is all about asking ourselves questions. Where do I want to be in 6 months, a year, 5 years, 10 years? What do I want for myself, for my family, for my kids? And starting to think about how to move that money around. This is to enjoy your money in retirement, but retirement is whenever you really want to start it. You don't have to be at retirement. You can still be working and have this flowing for you. There's no age to start it. So again, you can take that money here, the minimal withdrawals, you can actually throw it back into your RSP at the end of the year if you don't need it. And then trigger the tax deduction, which will then counterbalance, maybe not 100%, the amount of money you took out. You can take that money out of there, it's getting taxed, and then you can put it back in your TFSA and go get more free growth. I don't know, depending on the age you have, what's your situation. You can move it from the RRIF, you can move it into an RESP. So yes, you get tax on your overall picture, this adds to your income, but then if you come here and you move some money into an RESP, the government will match 20% of your contribution up to a maximum of $500 a year. So that's a guaranteed 20% return on your money, even if it's just sitting there doing nothing. So then you might want to take $2,500 here a year and move it into there for your kids' planning. Right? You might be 35 years old, 49, or 39 years old, and start channeling that money like that, right? And separating things so the money for the kids is here. You have money, extra contribution rather than letting it sit here or just getting taxed and letting it sit in your checking account. So those are the different ways that the money can flow. There's other plans such as LIRAs or locked-in RSPs, etc., etc. I'm not covering them all. If there's specific questions about any of them, please feel free to ask. Otherwise, I recommend that everybody makes themselves familiar with these kinds of programs and make sure that they maximize everything they can. I mean, like a free 20% return on your money, everybody should, to the extent that we can, and I believe that with a little bit of knowledge, everybody can, take advantage of this. You know, it's a pot of money that's sitting there that the government's sitting on collecting your taxes. So let's go get that back. I think that's pretty much all I'm going to cover for now to keep it nice and short, quick and dirty, as we say. If there's any question on this, please feel free to question down below in the comments or send me a direct message, and maybe I'll cover specifics of this or other things in other videos. And I'm happy to make as many as necessary as long as you guys want to talk about it and have questions, and I'll just keep talking, as you know. All right, guys, cheers. See you later.